Monetary policy refers to that part of economic policy pursued by a central bank that influences monetary and other financial conditions with the broader objectives of price stability, sustainable growth and high employment. The monetary framework comprises of A. The objectives of monetary policy, B. The analytics of monetary policy focusing on the transmission mechanism, C. The operating procedures focusing on operating targets and instruments. A number of developed countries, for example, New Zealand, Canada, United Kingdom, Sweden, have adopted price stability as the single objective of monetary policy. However, there are others. For example, Federal Reserve System of US, which continues to pursue multiple objectives of monetary policy such as maximum employment, stable prices, etc. Historically, countries that have experienced high inflation have a stronger commitment to price stability as the primary objective of monetary policy. However, most central banks have a pragmatic view that within the objectives of price stability, monetary policy has to stabilize swings in effective demand as well. In India, the central bank, that is the Reserve Bank of India or RBI, in its preamble in 1934 has spelled out the broad objectives of monetary policy, that is maintaining price stability and ensuring an adequate flow of credit to the productive sectors of the economy. Thus, monetary policy aims to maintain a judicious balance between price stability and economic growth. In the recent period, the question of financial stability have assumed greater importance in view of increased globalization of the Indian economy. Financial stability effectively means ensuring smooth and uninterrupted payments and settlement system, maintenance of a level of confidence in the financial system among all stakeholders and absence of excess volatility in markets that disrupts real economic activity. In this module, we will discuss in detail how India's monetary policy framework has undergone several transformations over the years, reflecting various macroeconomic and financial conditions.
After studying this module, you shall be able to know about monetary policy in India in the pre-liberalization period, monetary policy in India in the post-liberalization period, capital flows and monetary policy, interest rate policy in India. Let us start with understanding the term monetary policy. It refers to that part of economic policy pursued by a central bank that influences monetary and other financial conditions with the broader objectives of price stability, sustainable growth, and high employment. The monetary framework comprises of the objectives of monetary policy, the analytics of monetary policy focusing on the transmission mechanism, the operating procedures focusing on operating targets and instruments. In India, the Reserve Bank of India, in its preamble, has spelled out the broad objectives of monetary policy, that is, maintaining price stability and ensuring an adequate flow of credit to the productive sectors of the economy. Thus, monetary policy aims to maintain a judicious balance between price stability and economic growth. In the recent period, the question of financial stability have assumed greater importance in the view of increased globalization of the Indian economy. Financial stability effectively means ensuring smooth and uninterrupted payments and settlement system, maintenance of a level of confidence in the financial system among all stakeholders, and absence of excess volatility in markets that disrupts real economic activity. Let us go through the monetary policy in India in the pre-liberalization era, starting with years between 1950 and 60s. The primary focus after independence was on capital formation on a large scale and self-reliance. In view of the scarcity of domestic capital, there was a common consensus that public investment funded by printing money would facilitate the process of industrialization. The role of monetary policy during this period was creating the machinery for financing development activities all over the country and ensuring that the finances flow in the intended directions. The force provided by public investment to economic growth could not be sustained beyond the early 1960s, and the government deficit continued to climb steadily during this period. And this increase in government deficit, fueled by monetary expansion, led to a rise in inflation in the 60s decade. The steps taken by RBI to control this inflationary pressure were changes in cash reserve ratio and bank rate, interest rate controls, credit controls. Banks were forced to finance the large credit needs of the government.
The other objective of ensuring credit allocation to the priority sectors while meeting aggregate targets meant restricting credit to other sectors. In the beginning, interest rates were market determined, but market allocation was discontinued in favor of rationing quantities. Among the recommendations of the influential UK Radcliffe Committee of 1958 were that government debt and market liquidity management should be the focus of monetary policy, and too large interest rates variation disturb markets. Variety of devices were used to intervene in credit allocation. Apart from the interest rate controls and general credit guidelines to direct bank credit to priority sectors, selective credit controls were used to limit advances against certain commodities to mitigate speculative hoarding. At the same time, banks were forced to finance the large credit needs of the government. This period also witnessed an exchange rate anchor set by the proportional reserve system, whereby 40% of the total note issue was to be backed by gold bullion and sterling. The proportional reserve system gave way to the minimum reserve system in 1957. Under this, only rupees 2 billion worth of foreign securities and bullion needed to be maintained as a backing for currency issue, of which rupees 1.15 billion had to be in gold. Together with this, credit aggregates were to be used as the nominal anchor for monetary policy.
Let us look at the challenges faced by the RBI during the 70s and 80s decade, when there was continuous sustained inflation due to continuous excessive monetary expansion and too much deficit financing. Inflation became the main concern of monetary policy during this time. This necessitated certain changes in the monetary policy formulation in the mid 80s.
During the period 1970 to 1980, price stability emerged as the dominant objective of monetary policy. Price stability does not mean zero inflation. It is considered as low and stable inflation. A high inflation imposes costs on the economy by way of loss of output and misallocation of resources. For advanced countries, an inflation rate of about 2% was equated with price stability. For an emerging market economy, that is EME, like India, going through significant structural changes, an inflation rate of 4% was considered appropriate, as it allowed relative prices to adjust smoothly. In the 70s, there was a surge in inflation on account of monetary expansion induced by expansionary fiscal policies, besides oil price shocks. By the early 1980s, there was a broad agreement on the primary causes of inflation. It was argued that while fluctuations in agriculture prices and oil price shocks did affect prices, sustained inflation cannot take place unless it was supported by the continuous excessive monetary expansion generated by the large scale monetization of the fiscal deficit. Against this backdrop, the Sukhmoy Chakravarty Committee reviewed the working of monetary system, recommended a monetary targeting framework to target an acceptable order of inflation in line with desired output growth. It also recommended for limiting monetary expansion through the process of monetization of fiscal deficit by an agreement between the Reserve Bank of India and the government, with empirical evidence supporting reasonable stability in the demand function for money, and broad money, that is M3, formally emerge as an intermediate target. Under this approach, a monetary projection was made consistent with the expected real GDP growth and a tolerable level of inflation. The framework was, however, a flexible one, as it allowed for various feedback effects. Moreover, money supply target was relatively well understood by the public at large. The experience with the monetary targeting approach was not very satisfactory. Despite the adoption of formal monetary targeting, no specific monetary targets were set during the period 1985 to 1990, except for fixing a ceiling linked to average broad money, that is M3, growth in previous years. This was because there continued to be large overhang of excess liquidity due to primary money creation. The biggest problem of explicit monetary targeting was the fact that the RBI had no control over its credit to the central government, which accounted for the bulk of creation of reserve money. The Chakravarty committee recommended better coordination between the RBI and the government for arriving at the desired rate of growth of government expenditure and reserve money, and restrictions to be placed on government borrowing by way of treasury bills. On the contrary, treasury bills should be developed as an active money market instrument. However, the better coordination between the government and the RBI for restricting government expenditure was not achieved. Instead, the RBI would set limits on secondary expansion of money through instruments such as cash reserve ratio and statutory reserve ratio, that is CRR and SLR, and selective credit controls. As a result, CRR reached its prescribed ceiling of 15% of net demand and time liabilities, that is NDTL, of banks in July 1989, and SLR reached the peak of 38.5% in September 1990. Despite these measures, money supply growth remained high, which contributed to inflation.
The Chakravarty Committee of 1985 was set up by the RBI to look into the working of the monetary policy. It recommended monetary targeting to target an acceptable order of inflation, restricting monetization of fiscal deficit by an agreement between the RBI and the government, introducing flexibility in monetary policy to take care of feedback effects. However, they were not successful in keeping inflation under check. The experience with monetary targeting was not very satisfactory as the RBI had no control over its credit to the central government. During the era of globalization, monetary formulation changed, which made the previous regime of controlling money supply and credit redundant. An agreement was signed between the RBI and the central government on September 1994 to gradually reduce monetization of fiscal deficit. A new system of ways and means advances for the government was introduced in place of ad hoc treasury bills from April 1997.
Norms change the operating procedure of the monetary policy for the following reasons. A. Monetary policy had to increasingly contend with external shocks coming from swings in capital flows, volatility in the exchange rate, and global business cycles. The increase in liquidity due to capital inflows increased reserved money. This rendered the control of monetary aggregates difficult, and it also imparted instability to the demand for money. B. There was increasing evidence of changes in the underlying transmission mechanism of monetary policy, with interest rate and exchange rate gaining importance compared to quantity variables. C. Bank credit to private sector as a percent of GDP also started rising, though it still remained low compared to advanced standards, underscoring the potential for greater credit penetration. These developments necessitated the refinements in the conduct of monetary policy. Thus, the RBI gradually moved away from direct quantity instruments to indirect price instruments. The CRR and SLR were brought down to 9.5% and 25% of net demand and time liabilities. Gradually, a new operating framework for the monetary policy evolved, known as the multiple indicator approach, which laid more emphasis on price instruments.
With liberalization of our economy, monetary policy became free from fiscal dominance and interest rates were gradually decontrolled and became increasingly market determined. Capital flows were encouraged and the exchange rate was made flexible. These changes were necessitated due to the adoption of financial liberalization, whereby monetary policy had to increasingly contend with external shocks coming from swings in capital flows, volatility in exchange rates, and global business cycles. The opening up of the economy made it subject to various shocks which required an elaborate model incorporating many macroeconomic variables for proper formulation of monetary policy. The RBI formally adopted a multiple indicator approach in April 1998 to formulate the monetary policy in a period of heavy capital flows. This placed greater emphasis on rate channels for monetary policy formulation. The growth uncertainties in the functioning of the economy required this approach as it monitors a number of macroeconomic indicators. In multiple indicator approach framework, information content from a host of quantity variables such as money credit and rates of return in different markets, inflation rate and exchange rate are analyzed for drawing monetary policy perspectives. The efficiency of monetary policy under this approach is judged in terms of its ability to stabilize real economy activity and inflation and also ensuring financial stability consistent with policy objectives.
The multiple indicator approach is at times criticized as it does not provide for a clearly defined nominal anchor for monetary policy. However, it is to be kept in mind that globally the task of monetary management has become very challenging due to increased uncertainty in the functioning of the economy. A single model or a limited set of indicators may not be sufficient guide for monetary policy. Instead, an integrated data set is required which increases the importance of monitoring a number of macroeconomic indicators. The efficiency of monetary policy under this approach is judged in terms of its ability to stabilize real economy activity and inflation and also ensuring financial stability consistent with policy objectives. An assessment of the multiple indicators approach for the period 1998-99 to 2008-9 reveals that actual outcome of GDP growth has been generally higher than the projections indicated in the monetary policy statements, while it has generally been lower in case of inflation.
Let us study the method used by the RBI to control the interest rates in the economy. The mechanism of providing or sucking out temporary liquidity by the central bank through open market operations is known as the Liquidity Adjustment Facility. During the period of tight liquidity, commercial banks sell securities to central banks to receive cash, and the opposite happens during surplus liquidity. All commercial banks having current accounts with the RBI are eligible to take part in LAF auctions. The LAF does not involve the physical presence of securities as all transactions take place electronically. Thus, the interest rate channel becomes effective.
The mechanism of providing or sucking out liquidity by the central bank is through open market operations called OMO. During a period of tight liquidity, commercial banks sell securities to central banks to receive cash, and the opposite happens during surplus liquidity. The OMOs can take two distinct forms: A. outright sale purchase, or B. repurchased transactions, that is repos. Recently, the latter has gained prominence among central banks due to the following reasons. A. outright sale purchase of securities require a basic precondition, which is the existence of a liquid market for securities. B. securities get recycled under a repo operation. The mechanism of providing or sucking out temporary liquidity by the central bank is known as the liquidity adjustment facilities, that is LAF. The repo rate is not market determined, but a policy rate determined by the central bank, and so the central bank's repo rate, that is lending rate, is always greater than the reverse repo rate, that is the borrowing rate. In India, the LAF has put in place in phases in June 2000. Repo and reverse repo auctions are conducted on a daily basis. All commercial banks except regional rural banks and primary dealers having current accounts with the RBI are eligible to take part in LAF auctions. The LAF does not involve the physical presence of securities, as all the transactions take place electronically. The repo rate is changed by the RBI to affect market liquidity, but it is done in baby steps. This is because the policy maker does not know exactly what should be the change to bring the market back in equilibrium.
A number of other important changes were made to improve the working of the monetary policy. The Fiscal Responsibility and Budget Management Act was enacted in August 2003. This act prohibited direct borrowings by the center from the RBI except by ways and means advances. Interest rates on government securities became market determined and a secondary market of government securities developed. Full current account convertibility was established, although selective restrictions were placed on capital account convertibility. New market instruments like market repo and collateralized borrowing and lending operations introduced. These reforms made RBI more independent by limiting the amount of deficit financing, easing the flow of capital in and out of the economy, and the development of new money market instruments to help the banks and the corporate sector. Understand how the RBI managed excessive capital flow without increasing the money supply too much or letting the exchange rate fluctuate widely, thereby increasing uncertainty in the economy. India faced huge capital flows after 1991 and 92, which under a managed floating exchange rate led to monetary expansion. As a result, reserve money and money supply increases, which lead to the loss of monetary control by the central bank. The RBI took recourse to sterilization to offset the impact of monetary expansion. This essentially means selling government securities through open market operations and buying domestic currency so as to reduce domestic money supply.
India witnessed huge capital flows after 1991-92. This volume of external capital boosted domestic investment in various areas. However, excessive capital inflows has adverse effects as well. For example, in a flexible exchange rate regime, a sudden surge in capital inflows can appreciate the exchange rate. This makes exports less competitive. Together with this, reversal of capital inflows creates a huge wave of uncertainty which affects economic activity. Lastly, if the exchange rate is managed by the central bank, then capital flows result in a build-up of foreign exchange reserves. Then reserve money and money supply increases, and so there is a loss of monetary control by the central bank. In India, although the exchange rate was made flexible in 1993, however, for all real purposes, it was managed by the RBI. This meant that India faced the last of the three above mentioned consequences of capital flows. In the Indian case, using OMOs for sterilization was beset with a problem. The prerequisite for such OMOs is the existence of adequate government securities. However, given the magnitude of foreign capital flows, the paucity of government securities became a point of major concern by 2003. It was felt that during this period that the stock of government securities would be insufficient to sterilize all the inflows. In such a situation, based on the recommendation of a RBI working group, a new instrument named Market Stabilization Scheme, that is MSS, was introduced from April 2004. For market participants, bonds under MSS are indistinguishable from normal government securities. However, the proceeds of auctions of treasury bills and government securities under MSS are kept in a separate account maintained and operated by the RBI. Here, the amounts credited into the MSS cash account are appropriated only for the purpose of redemption or buyback of treasury bills or dated securities issued under the MSS. Payments for interest and discount on MSS securities are not made from the MSS account, but shown in the union budget as distinct components under separate subheads. The ceiling for issuing securities under MSS is fixed annually through mutual consultation between the government and the RBI. The MSS provides a convenient way through which excess capital flows could be sterilized with the help of additional government securities, and the government bears the cost of sterilization via issuing of government securities and paying for principal and interest. Interest rates are one financial variable that affects all sectors, consumers, corporations, financial intermediaries, investors, and policymakers. The history of interest rates in India, gradual transformation from repression to liberation. The RBI is authorized to regulate interest rates of banks under sections 21 and 35A of the Banking Regulation Act. This power was used extensively in the 1960s, decade by the RBI. For example, in October 1960, the RBI stipulated minimum lending rates. In March 1968, it announced ceiling rates for export credit.
Now let us study how the interest rates were progressively decontrolled. The Chakravarty Committee report in 1985 recommended freeing of interest rates for bank profitability. Deposit and lending rates have been gradually freed from 1990s decade. Restrictions on interest rates on saving deposits have been gradually withdrawn. Interest rates on small savings schemes, although fixed by the government, have been reduced for better financial market integration. The Rakesh Mohan Committee 2004 recommended using the secondary market yields of the government securities as the benchmark for the administered interest rates on small savings to ensure a level playing field in the financial market.
While the government is going slow on implementing the recommendations of these committees, it has reduced interest rates on small savings schemes for better financial market integration. The initiation of the multiple indicator approach has led to the repo rate and the reverse repo rate as the two policy rates which influence the entire interest rate structure in the market. The dual rate system has affected the pass through of policy rates on the market rates. Thus, in July 2011, the RBI constituted a working group to review the operating procedure of monetary policy in India. It suggested that there should be only one independently varying policy rate, and that should be the repo rate. This is expected to accurately signal the monetary policy stance. Also, the weighted average overnight call money rate should be the operating target of monetary policy of the RBI. These recommendations were accepted by the RBI. To sum up our discussion, India witnessed various monetary policy frameworks over the years in keeping with the changing economic situations. It is difficult to agree appropriate framework, especially in the recent period when monetary policy has to tackle various economic problems simultaneously. The multiple indicator approach is considered to be a major improvement over monetary targeting in a time of rapid capital flows. However, such a framework is found to be inadequate during a period of high inflation. India experienced one of the highest inflation rates among G20 countries between 2007 to 2013. This has raised inflationary expectations. Since 2007, several high-level committees in India, for example, Mistry Committee 2007, Rajan Committee 2009, have highlighted that the RBI must consider switching over to flexible inflation targeting. This implies an average inflation target is achieved over the business cycle, keeping the growth concerns intact in the short run. A recent committee, that is the Urijit Patel Committee 2014, drawing lessons from cross-country experience, recommends that inflation should be the nominal anchor for the monetary policy framework. The nominal anchor should be set by the RBI as it is predominant objective of monetary policy in its policy statements. This nominal anchor should be communicated without ambiguity so as to ensure a monetary policy regime which allows a shift away from the current approach to one that is centered around the nominal anchor. Subject to the achievement of the nominal anchor, monetary policy conduct should be consistent with the sustainable growth trajectory and financial stability.
Summarize what we have learned so far. In India, monetary policy in the 50s and 60s was dominated by the need to neutralize the inflationary effects of the monetization of the central's fiscal deficit. In the 70s and 80s, this trend continued, which led to the initiation of monetary targeting with feedback in the mid 80s to check money supply growth and thereby inflation. In the 90s, with the gradual opening up of the economy, targeting money supply gave way to targeting interest rates through the multiple indicator approach. Interest rates of various maturities were progressively deregulated so as to activate the interest rate channel of monetary policy.